Let's get to this week's Fed meeting. Joining us now, Dino, former executive at the New York Federal Reserve and current special advisor to the CEOs at CLS Bank International. Do you see any developments over the weekend that give the Fed pause for what they're planning to do this week?
It probably should have some pause, but I'm not sure that it will. They've given every indication that they're going to continue to raise interest rates. Their prime objective is to get inflation under control. I just came back from Europe, and the ECB is sending the exact same signals of, we've got an inflation problem. We're going to continue to tighten policy despite the banking stresses that we've seen there as well. Less so and centered in Switzerland there, but still the same kind of messages. So I'm not sure that we're going to get a change in view, but maybe we should, because this is now we've had the second largest bank failure in our history, and the third, all within a couple of weeks' time. Mm-hmm. And to the point Rick was making a little while ago, should we assume that this is it? Why can't this go a little bit longer? If for the people who remember 1994, the Fed raised from 3% to 6%. By the end of the year, Orange County was declaring bankruptcy. Mexico was in crisis. You had derivative books and bond books on the street that were all blowing up. So, is this it? Hopefully, but we shouldn't assume, especially if the Fed is going to continue to push policy tighter.
Well, we know that there's still duration risk that we may not know about. So the 25 basis points, it's not a lot, but I'm just wondering whether it would affect assets that have duration risk more than the positive effect we get on demand. What is it going to hurt? Somehow it's going to slow the economy a little bit more, which is going to mean inflation comes down a little bit more. The benefits seem, I don't even know if there are any to go. Just psychologically, we're still raising. Maybe that's the benefit.
Yeah, I mean, part of this probably is that the Fed took a credibility knock,
so now they
because of transitory, and now they kind of probably feel like they need to make up for it, reestablish credibility, show that they're not going to be they're not going to be dissuaded. And so they're probably going to keep on pushing it a little bit more. But I mean, to your point, there's a lot of unknowns. Right now, real rates had been, we spent 10 years with negative real rates. Now real rates are, roughly, give or take, zero, and probably we're going to be in positive real rate territory soon, with inflation coming down a little bit and interest rates still going higher. So, there's probably going to be more stresses that show up. And again, to your point, it's not just the banks, right? It's probably some finance companies, some insurers, other business models that the market will sniff out. Who was reliant on low interest rates, who is now going to be caught offsides? That's what they'll be hunting for.
The Fed knows this, right? I mean, they have to. They have to know a lot of this stuff before we know it. Do you think that they're giving enough concern to this when they're in the room, or are they just so worried about inflation still that they feel like they have to really? I
mean, you're really kind of identifying the trade-off, right? So they can see when you say it's the duration and the interest rate mismatch, and actually they see
tightening credit as a result.
It's true. They see it in their own balance sheet because the Fed's own profit and loss has gone from a big profit to a big loss because of the same kind of interest rate mismatch. So they kind of can see it. They understand that that lending has been trimmed back. That's in the data, and this isn't going to help this news over the weekend. But they've got to sort of make that balance between, do we prioritize inflation or do we prioritize economic growth in the near term? I mean, I'm kind of in the camp that thinks that we're going to have a recession by the end of the year. But their forecast has nothing, does not show that. Look at the dot plots, look at the speeches that the members are making. They're not there yet.
It's a conviction of the converted. We keep saying that. They stated 0 for 2. Now they're going to keep, they're going to keep laying it on whether they need to or not. But I would think that the downside is more than the benefit you get from another 25. If it's one and done, and they're going to, I just wouldn't even do it if they're going to.
Well, that's I'm with you. I think the last time that I was on, I said the same thing. I said, they probably will continue to tighten, but probably they shouldn't, because of the tightening that's in the pipeline is going to show up, a few months from now. And, by that point, it may be...
We hit 1% GDP. It was half expectations. And
yeah, I mean, to be fair, if Steve Leisman was here, he would point out that it was inventory and all that. I mean, but still, that will tend to... I mean, I'll be looking for the ISM number later, I guess later today, because right now that is pointing towards weakness. And that's been a pretty good indicator, along with some other similar surveys of the economy 3-6 months ahead. So I'd be looking for that. But yeah, I mean, right now we're looking on a slowing trajectory, and that's again, these banking issues are not going to dissuade them.